In today's video, we are going to delve into the common mistakes that a retail trader should absolutely avoid when interpreting the chart. Let's begin with the first point. It's crucial to always pay close attention to the size of the candle movement. Here we have a 5-minute time frame chart of Nifty 50, dated the 18th of September. In this example, the price initially drops after encountering resistance from the previous day's high. However, it subsequently moves upwards again and breaks through this resistance area with a strong bullish momentum candle. It then moves above and stays at the high level for a significant period of time. After trading near, providing retail traders the opportunity to enter long trades, the price drops rapidly, leading to significant losses for all retail traders involved. Now, the question arises, why did the price decline so swiftly despite the bullish price action observed in the market? If you know how to read a chart, then the answer to this question is hidden in this chart. Let's find it. On this day, the market opened gap down as compared to the previous day, due to which all the buyers who were holding their buying positions on the previous day are now out of the market. This means that there is still a very small amount of liquidity present in the market on the lower side, but the sellers who were selling at higher levels yesterday are making good profit today due to the gap down opening of the market. So they are still holding their positions here. They are maintaining their positions. This indicates that today, the liquidity of retail traders is significantly higher at elevated levels compared to lower ones. As a result, the price ascends swiftly, without delay, and surpasses its previous day's high. As a result, all the sellers here exit the market. Today, since the market has already trapped the sellers once, after this bullish momentum candle, more buyers looking for a breakout opportunity start building long positions. However, because of the psychological resistance level at 25,500 on the chart, few buyers choose to purchase here. But on the contrary, the market will not break this level today and will continue to trade below it. With this expectation, sellers start building their selling position here. Also, if you look from the perspective of price action, the closing of any bullish candle here has not been above the week high of this last red bearish candle. Also, the size of the candles here is getting smaller as compared to the bottom, and a long upper wick has formed in almost all the candles. This means that the sellers who joined the market here are repeatedly pushing the price down, due to which the buying pressure reduces, and because of increased selling pressure, the price goes straight down, grabbing the liquidity of buyers present in the lower areas of the chart. Hence, whenever the price forms such small candles on the chart while approaching a strong psychological level in an uptrend, it means that the momentum of the price has decreased due to the lack of interest of buyers here. And if the body of the candle becomes smaller when it is near a level, and then it becomes bigger than the body of the weak candle that is above it, this indicates that the buyers are trying to push the price upwards. However, they are consistently failing to close it at those higher levels. This situation suggests that the sellers are in a much stronger position compared to the buyers. In price action, we refer to such candles as rejection candles. These candles serve as an important signal indicating a possible reversal occurring in the market. That is why if such candles are formed at higher levels on the chart, one should avoid entering a long trade here. Here, the market has continuously formed rejection candles on the chart after this red candle. This situation indicates that sellers maintain control at this point. However, buyers continuously drive the price upwards, which results in their stop losses being positioned at lower levels in this region. Because of the heightened liquidity in this zone, operators entice additional buyers by demonstrating a breakout with these green inducement candles. Once the options premium rises due to a price spike, they capitalize by selling them at elevated prices. With more selling, the price drops fast. Now in this chart, we have analyzed it using the same 3 techniques that we mentioned in our price section series: endorsement of rejection candles, the smart money concept series, and liquidity of retail traders. However, these days, many retail traders are learning new aspects of trading on a daily basis. Yet when it's time to trade in the actual market, their minds often don't function effectively. This is because, by trying out new strategies every day, they end up confused and unable to concentrate on any single technique. Because of this, they keep entering and exiting random trades throughout the day without any analysis. due to which their emotions dominate them, and they repeatedly incur losses. So, if you agree with my perspective, then make sure to keep your trading approach as straightforward as possible. Plan your trade using only the essential elements. Remember, you have entered the market with the primary goal of earning money, not to learn every single thing and write an entire book about it. Therefore, concentrate on 2 or 4 techniques that fit well with your trading style. Try to become an expert in those by practicing them extensively on the charts whenever you have the opportunity. Let's proceed to the next point now. Number 2, always remember to look back. This is a 5-minute time frame chart of the Nifty 50 index, dated September 19th. In this chart, we can observe that the price, after initially trading above the crucial psychological level of 25,500, continuously declines and remains within the range of 25,500 and 25,400 throughout the entire day. As a result, the sellers who have taken selling positions in the market at these higher levels continue to maintain their positions. They are doing so because they are achieving substantial profits in this situation, given the consistent downward trend in the price. The market showed no bullish action until day's end, due to which the sellers here are confident about the bearish sentiment of the market. Next day, i.e. on 20th, the market cap opens up and once again continues its old worst trend, due to which some fresh sellers create their selling position again. Now, looking at the price action on the chart till here, it seems that the market will go down directly after eating the stop loss of buyers at lower levels, because the sellers are in a strong position here. But you have placed the stop loss of buyers and sellers here. The magnitude of liquidity being generated through the loss is significant. Once again, the quantity isn't considered because operators keep displaying bearish price action on the chart, drawing your focus that way. This behavior is leading numerous retail traders to view the market with a bearish perspective, and they are thinking of entering the trade in the same direction. But if you look carefully here, the market has given the sellers an opportunity to do short sale at almost these 3 levels on the chart. And only near this level, some buyers enter the market for long trade. But due to their small number, there is no big jump in the price, and the market closes at this level. But now, if you look at the quantity of stop-loss liquidity of retail traders on the long and short side on this chart, then here the liquidity of sellers is significantly higher on the sell side compared to the market. This implies that if the market were to decline further from this point, the absence of a sufficient number of viruses would result in the selling orders placed by operators being unable to be executed in large quantities. On the contrary, there is still a large amount of liquidity of retail sellers in the upper area, due to which operators create a bearish movement on the chart in such a way that due to the increase in the premiums of options, the market moves straight up by grabbing the liquidity present on the top by selling the price at higher levels. To avoid such a trap, you have to identify on which side of the chart the liquidity of retail traders is more and on which side it is less. In the market, prices shift from balance to imbalance and back. Stay focused on the chart and its patterns. When entering a trade, watch where retail traders plan to enter. Chart patterns show the best entry point for bigger profits with less risk. To decide trade direction, find the liquidity imbalance of retail traders on the chart. Let's now discuss the next mistake. Number 3, always identify premium and discount zones on a chart. This is a 5-minute time frame chart of Nifty 50 from September 20th. Here, the price surged from the bottom in a strong bullish trend, creating fair value gaps in several areas on the chart due to the formation of large green bullish candles. The fair value gap, also referred to as FE, indicates an imbalance in the price observed on the chart. In the future, when the price approaches these gaps, there is a significant likelihood that the price will bounce back from these points. However, to accurately determine the specific area where the probability of a price reversal is the greatest, it is essential to identify and mark the premium and discount zones on the chart. To achieve this, you should utilize the Fibonacci tool, applying it from the lower level up to the swing high. This approach will help in pinpointing the areas with the highest potential for price reversal. Now, in this context, the area ranging from 0 to 50 above will be referred to as the premium zone. Meanwhile, the area situated below this will be designated as the discount zone. In a bullish trend in the market, most of the time operators prefer selling in the premium zone and buying in the discount zone. Now, in this chart, one FVG is in the discount zone, while the other 2 are in the premium zone above. That is why if we want to make a trade entry on the long side, then our focus should be on the fair value gap formed here in the discount zone below, because there are more chances of the price reversing in this zone. In a short while, the price comes down with strong bearish candles, completely fills the fair value gap formed in the discount zone, sweeps away the liquidity here, and again goes up. Therefore, to take reversal trade in the bullish trend, you can take advantage of the discount and premium zone. Now let's determine which zone is considered valid and which one is not. Additionally, we'll explore which site engages in trading within a particular fair value gap. We'll delve into these topics thoroughly in the next video. Previously, we have created 2 informative videos discussing the 4 common reading mistakes. You can find the link to these videos in the description below, and I highly recommend watching them. If you enjoyed, like and subscribe. Thanks. In today's video, we are going to delve into the common mistakes that a retail trader should absolutely avoid when interpreting the chart.